there, and welcome back to Crypto Clarified, Investing in the Truth. This is a podcast series where we come together to discuss the most captivating headlines and trends from the crypto space. My name's Benjamin Dean. I'm Director in Wisdom Tree's Digital Assets team, and today I've got the pleasure of being joined by Tze Donn Ng, who's Associate at Tioga Capital. Kick things off, social media shout-outs. You can always find me on the Bird app at Benjamin Dean. If you're in the US, you're a US listener, wisdomtreeprime.com. Join the waitlist, you won't be disappointed. And make your life easier. Hit subscribe on whichever platform you are listening or watching this today. Today, Don and I are going to talk about a topic that comes up occasionally in our podcast series, and I hear more and more when I go around client meetings and speak with people in financial services. Tokenization. It's an awkward word. You'll hear it more and more and more as it's somewhat entering relative mainstream. Today, we're going to talk about what it means, why it's happening, where you can see it happening, and then we'll think a little bit about the future and where it might go. But before we get to do that, the usual shout out to James and Sam in compliance. I need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and Tioga Capital and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. Onto the fun stuff. Don, it's a pleasure. Thank you for coming and joining me today.
Awesome. Great to be here.
So to kick things off for our discussion today, how about you just let listeners know a little bit about you, how you got involved in the crypto space, and what you're working on now with Tioga Capital?
Yeah, sure. Happy to kick it off. Hey, everyone. I'm Don. I'm originally from Malaysia, came over to the UK to study, and that's kind of where I first got exposure to Bitcoin. So it's basically, studying information and computer engineering up in Cambridge. Got very excited about, both ideologically, Bitcoin as sort of digital gold. Also very excited about the cryptography side of things with the SHA-256 algorithm and all that. Was exploring the top 10 coins on CoinGecko, and as you could tell, I'm a little bit more excited about Ethereum, mainly around the smart contract capabilities, because I was studying a little bit about decentralized computing and all that. I think at that point it was all quite speculative because people were talking about smart contract capability, but in reality back then there wasn't any. So got into the whole rabbit hole about the ICOs, participated in some across Malaysia, London, and then have been following the space ever since.
It's a curious path to take. Yeah, SHA-256. Everyone loves hash functions. Super interesting, and I guess in a way also watching the smart contracts play out, because back in the day the charge leveled against it was nobody uses them for anything, and as you said, there was a lot of speculative stuff going on in 2017 with the ICOs, lots of stuff that just did not work, to be fair, but smart contracts do work and have evolved a lot since then, haven't they? So it's certainly something to keep you busy, I have no doubt. In terms of Tioga Capital, what do you folks focus on? Do you have any specific thesis or industry, or what's your story there?
Yeah, Tioga Capital-wise, I joined Tioga last year. It's a fairly young fund, founded in late 2020. We're a European Web3 fund, investing across all types of Web3 related startups globally. It's an $80 million, 65 million euro fund. Writing 500K up to 2 million checks in pre-seed to early Series A companies. We're a high conviction and lead investor. So far, 14 companies in our portfolio. It's just 16 members investing out of London, Brussels, and Portugal. Market thesis wise, we focus on sort of 4 pillars across Web3. I think the first one would be blockchain infrastructure and security. I think we've seen recently with billions and billions of dollars in hacks. We think it's increasingly important to invest in risk management systems as well as security systems there. Blockchain infra also includes scalability solutions and all that. I think the second pillar that we look at really is around regulatory compliance and institutional access. I think that's very much related to what we're going to talk about later as well. Third thing is about the creator economy and NFTs, and everything that enables creators to connect much more deeply with their fans through the basically owning NFTs. It's more like an internet native way of owning things, I think. And then I think lastly, on DeFi, which I think DeFi is a bit misleading because I think whenever people hear about decentralized finance, they get very uptight and very scared about what decentralization really means. But to us, I think it really just means on-chain finance and leveraging the cost efficiencies and the transparency, composability to bring about a much more efficient finance backend, really. Yeah.
So how is the space at the moment, the kind of venture funding space? I know things slowed down over the last year industry-wide, but at the same time, a lot of your portfolio companies, I imagine now, are like well into the building phase. Are they still making progress? They're still going? Something exciting's down the line?
Yeah, definitely. I think we saw the market slow down a little bit late last year, but we're seeing it starting to pick up again. I think building in a bear market tends to be the best because you don't have as much noise around. You just keep your heads down and just build towards your vision. So that's, I think, also a good time to be a venture investor as well. Lots of opportunities coming up.
Yeah, that's true. It does. There's a much less noise and hype going on right now. The only people who are left are the ones who actually build things. So indeed, it is a good time, and actually you get tons of signal out from all of your activity. And actually, it's a really great backdrop for the discussion we're going to have today. Tokenization, the ugly word. I wish someone had come up with something better for this word because it's not terribly satisfying. But alas, that's what we're stuck with at the moment. For the listeners, there's lots of ways that we can kind of pursue or explore this topic. Maybe, Don, if we could kick things off, from where you sit and the people you work with, when you hear that word tokenization, what do people mean by it?
Yeah, I think that's a very good question. And yeah, I agree. Not a huge fan of the word tokenization either. But yeah, I think tokenization in essence is really just, representing any asset on top of blockchain network. This can be Ethereum, Polygon, or anything else. I think what blockchains uniquely enable is really just transfer of value through the internet. Because I think in Web 1, you were able to read stuff on the internet. Web 2, you were able to, write stuff on the internet. But we haven't really, been able to transfer value across the internet. What it means is, just it's almost like sending cash through the internet, right? Which is a little bit different from, your Cash App, because one great example is, for example, when Ukraine was raising funds, it was almost impossible for you or me to transfer any sort of cash through, the traditional banking system. It would take days, lots of fees, but when they open it up for people to transfer things like Ethereum or maybe in the future USDC as well, everything just happened super instantly. So I think that is sort of the essence of what we mean by the internet of value.
Great. So there's a few things there for us to unpack for the listeners. One of them is that it uses this Web3 infrastructure, blockchains. So it's a way of storing information on distributed databases. That's it. Instead of the value, in inverted commas, sitting in a bank with its own set of infrastructure that's isolated from others, the entries are put on a distributed database that anyone can kind of interact with, right? The second one you were pointing at there is when you said sending cash. And so you're starting to get close to another buzzword, which is actually like kind of the killer app really for smart contracts. And that's the term stablecoin. I also don't like that term, but basically for the most part, they're US dollars. They often sit in a bank account somewhere, and then tokens are issued on these blockchains or distributed databases. One of the most popular is issued by Circle, regulated financial services provider in the United States. Another one is Tether. So let's think a little bit about stable coins and what you were just saying there. Like the quick story of stablecoins is they become wildly popular. I mean, you said at the top of the show
Mm.
you're from Malaysia. I remember being in Malaysia a few years ago, and people were using these US dollar tokens to pay across borders. Is that kind of something you've seen as well?
Yeah, definitely. I think one interesting startup in like the Southeast Asian space is called StraitsX. Essentially, they do both Singaporean dollar stablecoins and Indonesian rupee stablecoins, and it's increasingly becoming a very cheap way for people to transact do like cross-border remittances essentially. Yeah.
Yeah, right. And it's so for the listeners, all of this happens on like essentially internet native infrastructure. Anyone with a cell phone can use these. The apps are pretty widespread now. The number of different places you can get these tokenized Singaporean dollars or rupees or US dollars or whatever, the range has expanded. And then, because like everyone has a smartphone these days, um, it's as you said earlier, we can go into some of the benefits, but for a lot of these people, it's just faster and cheaper than the traditional banking system. Um, Unpack it further, though. I mean, what are some of the other benefits that you find from using these stable coins, tokenized currency, essentially, relative to kind of the legacy financial system?
Yeah, I think there are quite a lot of benefits, right? I think the five key ones that I can think of really. I think number one is the cost efficiency because you're removing a lot of middlemen. It's a highly automated system, fully run on code. I think it's not even just the crypto enthusiasts who are saying that it's cheaper. We also saw the IMF report from I think early last year, telling us that you know if you use DeFi infrastructure, it's about 3 times as cheap, right, compared to emerging market banks, or twice as cheap if you compare it to Western banks. I mean, looking at like PwC's report around, all the different parties that get involved in the securitization process as well, you're killing off a lot of, maybe not killing off, you're removing some of the middlemen, turning reducing costs greatly. I think secondly as well, I mean, faster settlement times and just 24/7 markets. I think the SWIFT system has worked so far, but it's a very archaic system. I mean, it's 92 out of 100, banks on there is still running mainframe computers. I mean, takes like T+2. It's crazy to think that in the age of the internet that T+2 is still the norm, which basically means that you settle 2 days after you initiate the transaction. But running everything on blockchain just makes a lot more sense because instant settlement, much cheaper. I think you have fintechs like Wise, which are sort of like band-aids on top of a broken financial system. It's essentially a P2P matching system for cross-border remittances. But if you want to transfer large amounts, something like Wise wouldn't really work because I mean you need an equally large amount from the other side. So I think that's kind of where crypto shines. I mean, other than that, there's a lot to unpack really. There's like the thirdly probably the composability and programmable side of things. It's almost like I like to describe it as a one size fits all financial API that anyone can build on top of. It's um, you know like money Legos essentially. For example, MetaMask built on top of a DEX, a decentralized exchange aggregator like 1inch or Llama Swap, and then you get the decentralized aggregator that which is on top of like decentralized exchanges like Uniswap, Sushi, etc., which is on top of Ethereum's, and you can just tap in and out of whatever system you want, and just get like the most efficient swaps simply by building just a part of the stack. I also think it's very operationally efficient. It's a lot more transparent. It's much easier to do accounting. I think in the 10 years ago, my parents were getting, maybe 15, 20 years, my parents were getting stock prices once a day on a newspaper, right? Now when we look back, we think it's absolutely crazy. I think in 20 years, we'll look back and think that it's absolutely crazy that we only get financial reports once a quarter and it's like 2 months late, right? Yeah, I think in the future, when everything is run on blockchains, it'll be increasingly transparent. You can just generate, reports. What is Facebook's revenue this second? What is Facebook's profits this second, right? I think we're starting to see that with, things like Steakhouse Finance. They're essentially live reporting MakerDAO's balance sheet essentially, and a few other you know kind of tokenization protocols like Swarm, Ondo Finance, etc. You can see everything live on chain. And I think, yeah, maybe just one final bit is really just around access, right? Whether it's access for Malaysians to hold USD, access for people in Nigeria, Venezuela, Turkey, places with high inflation to get access to USD stablecoins, or it could also be access for investors to emerging market credit, which is something that used to be gatekept for either PE funds or high net worth individuals. But yeah, I think that's the long story, long version.
It's comprehensive. And I was almost going to say at the end there, the access as well, because, a lot of people just don't have access to a bank branch or
Yeah.
US dollars or gold or whatever. And that last access point is kind of not obvious to a lot of people. I'll go to like Zurich and speak to Swiss private bankers, and they'll say to me, why do I need this? Like, I have cheap bank account transfers and it's all fine. I'm like, yeah, but you live in Switzerland. Not everyone else does. And
Yeah.
the other, so when they say to me, like, so why tokenize anything? I say what you just said: faster, cheaper, more transparent, potentially automatable. You use the word composable as well, which the listeners are now getting very well versed in. And that's all digitally native infrastructure. So it's quite a compelling package when you put it together for some people. And I said just then, gold. When I lived in Malaysia probably 5 years ago now, I met some folks who had started a company that was using the Ethereum smart contracts, and they were offering tokenized gold. That basically their business was based on the idea that a whole bunch of folks got wiped out, their savings got wiped out in the Asian financial crisis in the late 90s. They couldn't access physical gold, and they couldn't get exposure to like an ETF in Singapore or issued from Singapore. And so they had come up with this tokenized gold that they were offering smart contracts. So this was 5 years ago, that they thought it had a real use case. And so we're starting to see more and more different kind of asset classes be tokenized, which you've just hinted at. Some of them are like Swarm, based out of Germany. I think you said Ondo Finance as well. Backed Finance, based out of Switzerland, I believe. So what's going on there? Explain it a little bit to the listeners, like what these people are tokenizing, what they're offering, and where they're offering it, basically.
Yeah, I think we're starting to see like a renaissance of like bonds and to a certain extent, ETFs and equities coming on chain. I think, recently, I think you connected to me because of the article I wrote around Ondo and Unbacked. I think Ondo is an interesting one. It's, based in the US. It's only for qualified purchasers, which, has a lot of different requirements that you need to hit, such as, 5 mil, I think, in investments, a certain amount of net worth. There's KYC, AML, 100K minimums. But the cool thing about, Ondo is that there's a very unique ecosystem that they built. It's called Flux Finance, which kind of allows, long story short, it's a compound V2 fork. And it kind of allows people who are non-KYC to lend money to people who are KYC to buy these, T-bill ETFs, which sort of bridges the yield back to the non-KYC people. It's a bit complicated, but that's the long story short. Backed Finance is another interesting one. I think it's based in Switzerland under the Swiss DLT Act. The model that they go with is slightly different. It's bearer assets where non-KYC people will be able to purchase these the so-called backed assets, so B tokens from KYC people, and these KYC people can be custodians, can be market makers, etc. I think the unique kind of value proposition there is really just access, right, which is what we're talking about, allowing people anywhere to buy these tokens, of course excluding certain jurisdictions. I think you can't buy it if you're from US, you can't buy it if you're from Canada, and a handful of other countries. I think it's very interesting from a crypto native perspective, but it's a little bit more difficult on the regulatory side of things because technically U.S. citizens should not purchase it, but nothing's really stopping them from um, getting a VPN or going through different hoops, and it kind of opens up the door to a lot of money laundering, terrorism financing and tax evasion questions, which I think is a part of regulation is still trying to keep up, right? And yeah, I'm excited to see where it goes. Yeah.
Yeah, so let's dwell on that a little bit because what's interesting is the scene you just painted is you've got this technology and anyone with a cell phone can access it, really. And in all these different jurisdictions around the world, different people are finding novel ways in which to use this infrastructure. And then it kind of clashes against or works with and clashes with certain regulatory and jurisdictional issues. So you said there in Switzerland, the DLT Act. Can you quickly spell out what that is in just broad terms for the listeners? Because it's somewhat novel and it's kind of a good example of where if you're forward thinking, you can put something in place that facilitates people to make use of this technology, benefit from it, while also kind of making sure that everything's above board and any potential problems are mitigated or avoided.
Yeah, I mean, I wouldn't consider myself like a regulatory expert
Well,
of any
good.
kind.
That's no wonder you've got such a sunny disposition.
No, but I mean, from my understanding, from a very high level point of view, the DLT Act kind of just offers certain financial institutions or intermediaries, and it sort of creates a legal basis, right, for trading and issuing rights in the form of tokens. I think, yeah, it's one of the laws that's being used by quite a lot of startups within the space. I think, yeah, the most famous one being backed. Yeah.
Yeah. So listeners, you can go on and use the Google machine to find this out. The DLT,
Or
distributed ledger.
ChatGPT. Yeah.
Or ChatGPT, that's true, actually. DLT, distributed ledger technology regulations in Switzerland. And then you should also go and look at the electronic securities law that's been passed in Germany. Just because in essence, they become like this facilitating mechanisms and now I spend way too much time speaking to lawyers who would be specialists in these setups, but it's basically allowing people to put these assets on chain, tokenize them, and it's leading to a re-architecting of parts of how the financial system works in an internet native or digitally native way. That is happening organically. It wasn't happening as much a couple of years ago, but I think the stablecoins have really proven the killer app use case. There's demand there for it, and we'll see. Who is successful in managing to bring other assets on chain, tokenize them, or put them on a blockchain, or whatever other way we want to describe the same thing, right? So, all right, let's move on from the regulatory thing. We always have to cover it because everyone always asks. But are there any other kind of downsides or issues? You mentioned before that one of the pillars you folks look at is blockchain infrastructure and security. Is that something that we've seen kind of rear its head? You already hinted that it had, and I used to work in cybersecurity, so I know. But for the listeners who don't, what are kind of some of the security trade-offs or risks that one has to be aware of with this new infrastructure?
Yeah, I think what I was hinting at really is around composability being sort of like a double-edged sword. I think we've also seen this quite recently, right, with Euler protocol getting hacked. And it caused like a huge kind of chain effect on, Angle had, I think, 18 million USDC on Euler, and then Idle Finance, which is building on top of Angle, got affected, and then you had balances, four pools, affected by this token called BBUSD, which is like Euler boosted USD, which was also affected, which then infected Yearn, because Yearn had some Euler strats with Angle and Idle Finance, and then Alchemix was affected because of Yearn Vault. So you can see it's almost like a domino effect, and because everything works so well, this is what we call like atomic composability, right? With single transactions going through multiple protocols. it's useful because it's kind of like a universal API that anyone in the world can plug into. But it's also very dangerous when one protocol is affected. And there are many ways that can be used to avoid it. I think, for example, one of them is just having much better risk management and understanding how if your protocol uses staked ETH, for example, what happens if someone does a governance attack on Lido? What happens to staked ETH in that sense, and how would that impact your protocol? You could have circuit breakers as well, or you could have some people are discussing about reversible transactions, which is a bit of a more controversial topic. But yeah, I think there are lots of ways you could you know sort of mitigate and avoid this. You could also have rate limits, which means any transaction above certain amount needs to go through certain maybe votes or certain other methods which approves it. But yeah, I think a lot more work needs to be done in the space. On this front, we invested as a fund in Chaos Labs, which kind of sort of allows you to do economic simulations, right, to see what sort of attack vectors could destabilize your stablecoin protocol or your lending protocol. But yeah.
You've touched on a lot of really interesting points there. So let's recap some of them, because even I actually hadn't appreciated just how much you get the systemic risk now compared to 5 years ago. So these DeFi protocols, some of which involve or allow for the trading and exchanging of these tokenized assets, they're smart contracts, they're computer code. And as Don was saying, one of the benefits here is that you have a set of composable pieces. That is, they, like you said, like almost Lego blocks that you can click together. And in the past, it was a really, really nascent industry. You had people, writing up these smart contracts out back on the porch and then deploying them. And we found a lot of them had security vulnerabilities. They just didn't work. They broke. There's a lot of reasons why smart contracts will fail, accidental and malicious. But over time, as this ecosystem of different composable applications has grown, the stakes have gotten higher, of course. And as you say, we see these incidents now. The stakes are high. So if you can go and break one of these smart contracts and steal the funds, you can make yourself very rich very quickly. So there's a huge incentive to go and break them now. And then, as you say, if someone breaks one piece of the system and other pieces are reliant upon it, well, then you end up with the systemic risk that just did not happen in the past because the ecosystem wasn't as large or as complex, but is now something that people have to take very, very seriously if they think this stuff's going to go even more mainstream, or we're going to have more and more money or assets kind of reliant upon the integrity of the system. Moving on then, in terms of there's one thing I hear a little bit, and some people claim that with all this tokenizing, it will in essence kind of unlock a whole lot of illiquid assets out there that right now are not liquid. And there's something about the way this is set up that means that it might unlock these assets. Have you come across anyone claiming that? I sometimes hear people say tokenized real estate. That's one they point to a lot. Do you hear this or see this at all?
Yeah. I think we're seeing quite a lot of companies, startups just building in tokenized real estate, tokenized PE, VC funds, tokenized collectibles that can be watches, wine, art, cars, anything. You could also tokenize credit, right? Because these loans are essentially getting closer and closer to what bonds are, because the innate nature of just being tokenized. But I think what we're always missing, I think, is I think a lot of startups are starting to fit a solution to a problem, and I think it's increasingly more important to find a problem to solve. Right? I think one kind of example I like to give is, I'm sure a lot of people have heard about Masterworks. So they tokenize art and allow people to buy $20 shares in a $20 million piece of art. And I mean, they started off as a crypto company, as a blockchain company. They were tokenizing stuff in Ethereum, and then they realized that they didn't really need to do it on a blockchain, simply because that's not what the customers needed, right? What the customers wanted really was just exposure to art. I mean, TBC if Masterworks is successful or not, but I think it's at least a good experiment to show that you don't need to tokenize everything on a blockchain. You need to find a problem and solve it. I mean, that's what startups are supposed to do. Yeah.
Yeah, and that's what the stablecoins did essentially. I mean, the problem was people would go on crypto exchanges, they'd move their money from their bank account, and they didn't want to have to move it back. But they did want a US dollar substitute, or they wanted exposure to US dollars. So crypto traders
exactly.
come up with it.
Yeah, I think stablecoins are like one of the first kind of asset classes to reach so-called product market fit, right? I think there's like $150 billion worth of stablecoin out there. But what we increasingly see in terms of product market fit in crypto and the real asset side of things really is around like private credit. Starting to see that, just like what you said, stablecoins enabling people to hold on to cash on blockchains, right? Credit is enabling people to invest in emerging market credit, whether it's Goldfinch or Blue Jay Earn in Singaporean or Indonesian kind of credit, or credits in Latin America, or lenders in African credit. I think it's one of the few things I think we're starting to kind of slowly see PMF in those kind of areas. Yeah.
Yeah, it has to happen somewhat sequentially as well, right? Like for there to be demand for that kind of a product, people have to have had the tokenized US dollars, the stable coins to begin with.
Yeah, exactly. I think that's one of the key things that when people ask, why now, right? Because people have been tokenizing shares, bonds since 2016, 2017, albeit on like permission blockchains and all. But I think, one of the key questions that a VC asks is, why now? Because we invest across a 5 to 10 year horizon, and if we think it's too early, it might not be a good investment now, even if you're building something great. And that's spot on. That's exactly why now. Yeah.
Yeah, it's the whole. There's not just a good idea. There's execution, and then the execution has to be done at the correct time, right? You can be too early. It's better to be too early than too late in many cases, but still, one thing at a time. We're coming up on time actually as well for this episode, but that's a nice little segue point, because usually finish up the shows, we ask guests what they've got their eyes on, what they see on the horizon, what they're paying attention to. You're actually a really great person to speak to with that question, because as part of like your day job, you have to be keeping an eye on the horizon. You've just hinted at one there, which is tokenizing the bonds credit part. What else has got your attention? And it can be as broad an answer as you want. It's really meant to be more of kind of a point to ponder where the space is going or where it might go in the near future.
Yeah, definitely. I think on the on-chain finance and real asset side of things, I'm particularly interested on the stablecoin side of things, particularly non-USD stablecoins, or maybe Euro stablecoins and emerging market stablecoins, both centralized and decentralized versions of that. I think both types of stablecoins have a place in in the economy right now. Centralized stablecoins wise, obviously, as we've touched on, it's very dependent on regulation, whether CBDCs, central bank digital currencies, start to get introduced. We're starting to see lots of pilots on that, so we're closely watching the space. I think secondly would be emerging market credit or different forms of credit on chain. I'm starting to see a lot more startups around supply chain financing as well, and bonds on chain. We also recently invested in PVO1, which is a bond tokenization startup founded by the former founders of B2C2, so Maxim Bunin and Flavio. We're also paying attention to the payment space, simply because I think it's the clearest use case for crypto, and we're starting to see non-custodial crypto cards and lots of payment rails and payment infrastructure. I think last but not least, just going back to the roots of what blockchains are, right? You want like a very scalable blockchain, able to transact. Ideally, whenever people say like 60K TPS, transactions per second, that's enough, I always say no, because we're not comparing ourselves with Visa, Mastercard, right? Blockchains need to have infinite transactions per second and not be affected by any other activity. So, and on that note, we're looking quite deeply into the rollup as a service kind of space. What it means is every app is a rollup on top of whatever blockchain, and they get to control fees. They're not affected by other people's transaction activities. You still want to buy your bond if someone is minting an NFT, right? So I think it just makes sense fundamentally. So I think that is where a lot of our focus is at.
It strikes me listening to you that one of the other reasons, why now might lie in that increasing scalability. Like a lot of these layer 2 things for Ethereum are coming online. They're competing against one another. But, one of the big obstacles for use of stablecoins in the past was it was so expensive to use the Ethereum network that there's just a whole lot of transactions below a certain amount that just aren't economically feasible. And if that starts disappearing, that fee starts going down, it totally changes the economics of why you might want certain kinds of tokenized assets or currencies or whatever's. And people might use them in greater numbers because just now makes economic sense to do so. So that might be part of the why now, but there's plenty of other reasons why now. Any final thoughts before we close up shop for the day?
No, it was a pleasure talking to you, man. You have a really good way with words.
Well, I have a way with words, as the listeners know. But it's been a pleasure speaking with you today. It was a super interesting discussion. Where can people find you on the interwebs, Don?
You can find me on Twitter at Tze Donn. That's TZEDONN, or on Substack, same name, so tzedonn.substack.com. TZEDONN.substack.com.
Nice one. And with that, I think we're out of time. I hope everyone's found today's podcast useful and informative. If you're in the US, join the waitlist at wisdomtreeprime.com. You can always see me on the Bird app at Benjamin Dean. And as a reminder, if you'd like us to cover any specific topics in a future episode or to find out more information, please email the snail mail cryptoclarified@wisdomtree.com. Thank you again for listening. Don, a pleasure, and we all hope you have an excellent day.
Awesome. Cheers.